right, hello everybody and welcome to another Pepperstone Learn It Live webinar. Today we'll be talking about trading, of course, the US election. This is part 3 of our 3-part series where we go through really the different instruments trading into the election, talk about them from a technical standpoint, and talk about some of the ways that we're approaching everything moving forward. And obviously we've seen a lot of volatility over the last week. We've seen a lot of increased movement in things like the US dollar, gold, all of the other commodities, and of course also stock markets around the world. And I think that leads to a very exciting discussion tonight about into the election and how we're going to be technically looking at the markets. My name is Thomas Atkinson from FX Evolution. As always, I'm joined by Tyrone Abella. How are you, Tyrone?
Yeah, good, thank you. Yeah, we're getting very close to the election now, and I think the markets are starting to reflect some of that action and some of that volatility as well. So we'll look at some live examples tonight as we explain the technical aspects of trading this interesting market. It only comes around once every 4 years, and this is certainly one like no other. So we're looking forward to getting into it.
Just a quick risk warning before we get started, Ty. I just want to let everybody know that if you're watching this video or webinar, the information contained in this video is generic in nature and for educational purposes only. The information does not take into account your specific personal objectives, financial situation, or needs. This information is, of course, not made for you making a financial decision, and you should seek independent financial advice if necessary. So as we've been doing throughout these weeks, Ty, we've been discussing some of the great tools that Pepperstone have, and one of those is the Telegram group. You should be able to see a link about that, and you can also visit us as well if you want to by going to our YouTube page and searching FX Evolution, and you'll pick up some of the videos that we create on a daily occurrence if you're interested in that type of stuff. This video or this webinar will be recorded, and of course we will be uploading it to the Pepperstone YouTube as well. So what are we going to be covering today, Ty? We'll be taking a look at some live chart analysis of Forex, and I think also worthwhile looking at gold at the moment. We'll also be taking a look at the key indicators to use in MetaTrader 5, some scalping strategies for part-time traders, as many of you out there will be still part-time traders trying to, of course, get to the full-time goal, and then some live Q&A with our team. If you have questions, please feel free to ask them throughout the webinar as well, and we'll answer them as best we can so that you get a good answer of some of the things that you might always have wanted to ask. Remember, whatever you ask as a question, usually other people out there, the hundreds and if not thousands of people that are viewing this, will have that same question. Now, what are we talking about when we're coming into a US election? Well, we're obviously talking about US election news. We'll be mentioning that in just a minute, but we still cannot lose sight of the importance of general fundamental news. That is red news on economic calendars, and of course, yellow and moderate news. So basically the lesser types. Now, if you're trading a particular currency, it becomes very important. If you see monetary policy statement for the New Zealand dollar or the cash rate, that particular announcement, if you're scalping a 1 minute, 5 minute chart, can be incredibly disastrous or possibly very good for your trading account. But generally it doesn't work out like that, does it, Ty?
No, that's right. Yeah, and picking the news or trying to attempt to pick the news in any direction is always fraught with danger, but especially at a time where the markets are a little bit on edge already. So yeah, the market's already starting to feel I guess the intricacies of any decisions that are happening. There's a lot of elections happening actually. It's not just in the US, like New Zealand's just had theirs, and there's a lot of state elections happening in Australia as well. So there is a lot going on. Yeah, absolutely a lot going on at the moment.
There certainly is, Ty, and that brings me to unforeseen volatile news. So I just took a quick snippet. This is from Bloomberg. Obviously, it's not that important, this particular one, in terms of this article, but overall, the idea of things changing all the time. We've had stimulus talks in the US. Now, we might be trading currency, and we might think, well, why does that matter to what I'm trading at the moment? It certainly does, especially into an election. Whether there is a stimulus or not is becoming an important thing in the US. There's a whole bunch of other fundamentals around it, but this is what we call unforeseen news. We know there might be stimulus discussion, but if it falls through or if it takes longer than expected, these are the type of things that can instantly move a market, potentially 100 pips, if not 200 pips on a currency, and it can move so fast, so quickly, it can really do damage to your account. So we need to be aware that coming into the election, we may have a different trading strategy than we usually do. Maybe we're a swing trader or a long-term holder. It's going to be very difficult to hold potentially into the US election. We might see a day where, I remember when Trump was elected, Ty, we had a movement on markets around the world that was multiple percentage points. It didn't matter what you were trading. The stock markets, in fact, moved about 5 to 7% each way on that one day. So very large moves and very high risk. Lead indicators into market sentiment. Now, these will also move currencies because of the nature of what they mean. The key one that you're wanting to look at, or the two that you're wanting to look at as a currency trader, is US dollar index. Always have that analyzed and always know where that is, especially if you're really doing any type of trading. And then the volatility index or fear index. Now, Ty, how many traders often underrepresent these in their trading, I guess, technical analysis? If you're just trading the euro and the pound, you may think I don't need to do this, but you certainly do, don't you?
No, you do, and having the overall picture of what's going on and including these in your checklist. Look, it doesn't mean that you have to do it every single minute, but it's really important to probably have a very quick look at it, at least in this time of the year, especially probably every day before you trade. But it's not like you have to do it all the time. After the election, when everything settles down again, checking these probably on a weekly basis would be just fine. But at the moment, it's vitally important that you check, pretty much all of those actually that you've got there, or at least 3 of them: the volatility index and the dollar index, especially because there's not too many currencies that don't get affected by that. Just to give you a bit of an idea as to what is actually happening around you, because that does change literally on an hourly basis at the moment, and up until basically the next 3 weeks, we're going to see a lot of movement there.
Asian into European session, dollar moves today, Ty. I'm sure anyone that's been looking at the chart, wild. Very, very, very long, big moves on the dollar index this week coming into those stimulus discussions. Before we go and have a look at the live charts, though, I just wanted to discuss this thought process, and that was that we have seen some synergies over the last couple of months between the odd US dollar and the S&P 500. Now, many people out there trade the odd US dollar. I'm sure, being an Australian, obviously, many people in Pepperstone are Australians and just trade it just generally all the way around the world. Here is the comparison of the last couple of months. This is the daily chart. And I wanted to bring this up because what we'll see is that when the stock market, this red one, has been selling off, generally we have seen weaker odd versus US dollar. The same thing is happening at the moment. We're seeing some downward pressure being put on odd. Now, that's different to what we're seeing on euro and pound right now versus the US dollar. And we'll be looking at those in the live charts. So let's actually go over to the live charts and talk about this odd US dollar. So here's the odd US dollar. We've got here the daily, and we've got an RSI underneath. So we've got the relative strength index under here. Now, why is this an important kind of chart to be looking at? Well, I think this 70-20 zone is really important to discuss on the odd US dollar right now, Ty. We've got the 20-50 exponential moving average crossing each other on the daily. Now, is that important to us as a 5-minute, 1-minute scalper, or a 15-minute swing trader, or whatever? Not swing trader, sorry, day trader, or anything like that? It is, because it's showing us that we're getting to a critical point in the market. And when the market moves past a critical point, it often does so explosively. We talk about that explosion and that gap fill quite regularly. We say that this is something that a lot of traders and a lot of investors don't utilize enough. We had resistance, support, and now support again, all the way through this 70-20 area. And Ty, do you want to just quickly talk us about 70-20? It's different to just 70 cents, isn't it?
Yeah, most definitely. And look, it is obviously at a very, very key level here. Like, there's no, the arrows are pointing at that support and resistance zone, which is obviously a very, very strong role reversal. But we are getting conflicting signals here now. Like, we're getting a 20 and 50 cross. The 20 and the 80 that Thomas is alluding to they're really, really important numbers, because it's kind of the catch zone where people don't really know. Like, a lot of people say it's going to gravitate to the 00. Okay, so when we say 00, we're talking about 70 cents or 71 or 72, so the round numbers. But it's actually amazing when you actually draw up lines how often the 70-20 and the 69-80 in this instance would catch so much of price. And a lot of when the price is a little bit uncertain as to where it's going to go and it does get trapped in the zone, quite often it's going to hover in that 40 pip range between the 80 and the 20. And quite often, even when it is starting to go down to a 00, is what we'd like to call it, the 70-20 in this instance would be a real catcher for it. You'll be surprised how often the 20 will pull it up, even if it's only for a short time, before it does eventually work its way down to the 00. So And that's not just a this time of year approach. It's actually very, very often that you're going to see that thing happen in the market. So certainly worth checking it out. Draw up the 20s and the 80 zones on your charts, and I think you might be surprised how often price gravitates inside those zones, and it does actually give you some really good scalping opportunities to do that when the market is not trending.
I remember, Tyrone, go backing a little bit here, 2010, 2009, we were drawing 20s, 80s, double zeros on charts, euro US dollar, pound US dollar, odd US dollar, and then seeing the interaction with those zones. A lot of traders will tell you, especially professional traders, they'll say we focus on a few instruments, we focus on a few currencies, we become experts at those currencies, and we understand how they move, the times of days they move, the structures, the breakouts. There becomes a sense of, kind of a normality that happens around those particular pairs. And by just putting on the horizontal 20, 80, double zero and seeing how those levels hit, what you'll notice is that when it's between the 20 and the 80, you might have better trades that move to those directions, that gravitate to those zones each way. And that can help you a little bit as an edge in scalping and, of course, day trading. So the odd dollar is basically right here at the 70.20. It found it today, it's found some support, and it's bounced up. But I wanted to mention the Australian dollar, Ty, because really it's about this 20 exponential moving average and about what we've been talking about heaps throughout this entire crisis period and just the last couple of months worth of webinars. If we were to pick one indicator on our chart, and I think this is relevant to smaller timeframes, we'll show you one in a minute, the 20 would be our pick. And why is that? Well, when it comes back one time and two times, remember the 1, 2, the 3 times, the third time it comes back is often successful at finding dynamic resistance or dynamic support. Whether you're a 5-minute, 1 minute, 15-minute, 30-minute, I don't really mind what time frame you're looking at. The third time is quite accurate with the 20, as in you would be buying in the direction of trend. And a lot of scalpers and day traders, they try to go against the trend. You're better off sticking with it and going with the more likely thing to occur. And look how many times it hit this 20 on the way up. We've mentioned that heaps of times, a lot of buy opportunities through this. Now it's the daily. So we think, okay, well, that's the daily. But if we go over to other pairs, we go over to things like maybe euro odd right now, or even on smaller time frames, the 15-minute euro US dollar right now, and we noticed how many times it came back to this 20 and bounced off it. Yes, it's closed below now and we can't be using that anymore, but there was quite a few opportunities throughout this to get into scalps, and we could bring in things like RSI, stochastic, see whether those were going into overbought or oversold. What we'd want to be doing, Ty, is we want to be going to the higher time frame and finding the 1, 2 reoccurrence, and then dialing into the smaller time frame, drawing that up, lining that up, and then finding the opportunity on the 5-minute, 1-minute charts. And we can always do that. We can use multiple time frames or our top-down approach to get an idea of a great area and then pinpoint that area on the smaller time frames. What a great idea, hey Ty. It's the difference between, just looking at one time frame and looking at heaps is a difference between a lot of success and failure, I feel. Got a question here actually from Warwick. He says, funny about sticking to that one. Heard that from Thomas a long time ago. Well, Warwick, one thing we are is consistent with our approach on those things. Sticking to it, absolutely. Yeah. We do want to stick to it. And I can remember I've been saying that for 5-6 years on these webinars for sure.
Yeah, that's right. Look, the thing is with the moving averages, a lot of people don't realize, especially traders who are just starting out, that the moving averages are adaptive to the time frame that you're on. So a 20 moving average is adaptive to the period that you're on, right? So on a daily chart, it's going to represent the last 20 days. And on a 15-minute chart, it's going to represent the last 20, 15-minute candles. So yeah, it's the one that we use as our go-to all the time because it's simply the one that price does gravitate to no matter what the situation. It's very rare that it breaks away from a 20 and doesn't retrace to it at some point. Now, you're going to be able to use that. Look, there's no question moving averages are best used in a trend, right? They're a trend indicator. There's no question about that. They're the easiest to use when you've got a market going up, like you can see here on the euro odd 5-minute. We'll switch to a 5-minute now. But the story,
because the aggressive move this week, I'm sure many people got onto that one.
Yeah, the story is exactly the same. You know, it does gravitate to the 20 moving average, and it gives you the opportunities to buy. Now, the reason why the moving averages are so adaptive in a trending market is because they're giving you the signals to enter, and they're giving you a really good shortcut to actually get involved in a trend. What you don't want to be doing when a market is trending, because a lot of people say, well, all you've got to do is go in the direction of the trend and you'll be right. And that's all good and well, but where do you enter? Okay, that's where people come a little bit undone. And what a lot of people do is they have the FOMO effect where they think the market's going without them, and they just place the order because the market's roaring. And then consequently, a lot of the time it'll come back to the 20, and you'll find a lot of people put their stop losses right there, and it'll take them out, and then it'll turn around and continue on in the direction that it was going anyway. So when you're following a 20 moving average, you're giving yourself an opportunity to join an existing trend on a pullback, okay? And that's what makes it so important.
Yeah, joining the trend is the hard part, Ty. It's the difficult part that many traders, everyone wants to go against it because they think there's more profit in that. Well, it went up this far, I can go back and I can make money from it. It's just the wrong approach. It's hard because we don't like buying the price, but buying the pickup into the 20 moving average, it allows you to get a slightly dip sensation in that move. You're not buying the peak, you're buying a slight pullback through that move. And that actually is much easier to stomach as a human being in the psychology. Getting that slightly better price than someone else has, hey, that feels good to me. And I know I'm always happier when I do get a slightly better price. Hey, it always has been a thing for me. I agree with that one. So times to trade for part-time traders. Well, it depends what you want to be doing. Now, I bring up this slide and we've talked about it, but into the US election, we're starting to think scalping, day trading. We're now only 2 weeks out from the US election. If you're putting on a swing trade and you've got a longer term approach, okay, that's fine. No problems if that's your plan. But if you're somebody that's looking at a really large, long time frame support resistance, unfortunately, due to that unforeseen news, maybe we don't have a debate in the US, maybe something happens and a tweet is pushed out or the stimulus happens or something like that, all of a sudden, you'd rather be probably scalping and day trading and be able to be more nimble in the trade. So the way that I look at that is that we want to be focused on certain times, Ty. We want to be focused on 30 minutes to 1 hour before market session opens. And this depends on, of course, where you want to trade in the world. We've got people joining us from probably the US, we've got Europe, we've got London, we've got of course, Australians, and all the way through the Asian area, and it really depends on what time frame you're going to be able to do it. If you can only trade the European session, well, you want to get in there usually 30 minutes to 1 hour before, and then focus on the currencies that are around that European session, the pound, the euro, all of those types, the euro pound, the crosses, all those types of things will be best during that time. They'll set up before the opens, and then of course they'll trade throughout the session. We want to target things like breakouts right now, I think is quite strong. I'm not sure if we're going to see so many breakouts come back because of the nature of the aggressive markets due to the increased VIX, which we will talk about. And then, of course, we want to be looking at maybe moving average pullbacks throughout that trade. We saw the Euro odd break up this week. In Pepperstone's Telegram group, they mentioned that. I think Chris mentioned that one as well. And that particular trade was very aggressive. And as we saw on the 5-minute chart, the 20 was holding it multiple times throughout that move. And you can bring in stochastic and RSI as well. So the types of strategies become really important, Ty. I mean, what's your favorite type of strategy? Is it the pullback to the MA, or do you think it's more finding the patterns within the trade? I think you might be answering a question. So I'll answer it with my one. And that's going to be, probably for me, I actually really like roll reversal and a moving average. So what I really like is, I'm going to draw it for everyone right now. The move happens, let's say we had a consolidating market. Then we have the move starts, the pullback occurs, and the pullback might occur to a previous kind of resistance. So what we're going to see is we're going to see a move up again, and then the pullback occurs. Now, when this pullback occurs, we've got a resistance over here, and of course, that is going to become a support zone due to roll reversal, which we've talked about many times in these webinars. And we've also got a 20 potential moving average at the same zone. Now, we're bringing together a whole bunch of things here. We're bringing together the idea of resistance becoming support. We're bringing together moving average. Then we can bring in 1 or 2 other indicators. Some good ones that I think are worthwhile bringing on: RSI. RSI maybe pulls back to a 60 or a 40. Let's have a look at that on a chart just quickly and see what RSI looks like when we put it on a chart. So here's an RSI, and here is, of course, stochastic. Now, if we went over to a 4-hour chart and we had our lines up, I'm talking about basically if we're in a long trend and you're seeing a bullish movement and you're excited about it. Let's go to the 1 hour here. And you're excited about potentially getting some opportunities. Often that the aggression will be very, very fierce like it is here. Sometimes it'll be a lot slower and more technical. When it's slower and more technical, often the RSI will pull back. So it'll move up, then it will pull back to the 60, then it will move up, then it will pull back to the 60, and those types of things. Now the 60 can then provide you with an opportunity. We could have, let's say this was resistance, the market would then come back, test that level as support, test it with the moving average as well, and we might have a pullback to a 60 or an oversold stochastic at the same time, all in the direction of trend, all using price action. We have 3 to 4 reasons to be in the trade. That's the important part. 3 to 4 separate reasons to be in a trade, not just one, which is price action, not just one that's the moving average. 3 to 4 reasons. You've given yourself a statistical edge, which is the most important part of trading. Statistical edges, certainly very, very good. Warwick here said, and I think I'll answer this one right now. He says he is really listening to the dialogue right now, and that he says that there's subtle clues and things that just hit him and basically make sense to him. And I think that's an important thing. Sometimes, and I was talking to somebody about this in trading today, there's certain things that I've heard over the years, whether they're Warren Buffett quote, whether they're a Stanley Druckenmiller quote. I like those two investors long term, or a trader in general. When you hear something, it might just stick with you, and then that one thing completely changes the way that you think about trading into elections, into anything in general, and it can save you a lot of money. So it's that decision to actually go, wow, that just resonated with me, that makes the big difference. So times to trade for part-time swing traders. Well, the good thing about swing trading generally is that you only have to check the charts 1 to 2 times per day. Now, coming this close to an election, only 2 weeks away, you're probably going to be wanting to look at those levels, analyze those levels, and then if you see a clear break through that level, let's say again the Euro odd this week where it broke through the resistance, then you can go into the smaller time frames and scalp or day trade in that direction of the swing trade trend. Maybe don't take it for the whole distance of what you think, and that's because if you're swing trading, you may hold a trade 1 to 2 weeks, possibly at least a couple of days. When you're doing that, you're taking a risk of being in the market. And we all know that with high volatility and high unforeseen things, that overall that could be risky for us and risky for our trades. So when you find a good break of a daily, let's say the Australian dollar, US dollar gets under 70 cents, then you might go into the smaller timeframes and start scalping or day trading on the direction down if that's what your system's telling us. So instruments are going to be very, very key to pick, and I think it's going to be key to pick your times and all of those types of things. Whether the Democrats or the Republicans win, obviously stock market performance is going to be a factor here to every other market in the world. Whether we see people hedging into dollar index or people getting out of dollar index and taking what we call risk on in the stock markets, there is going to be a big factor here, and it's going to be predominantly probably driven by stock market sentiment. And I bring this up because when we look at our top-down approach, it also includes multi-time frame and multi-instrument assets that we want to be looking at. Now, we might not trade, let's say, the NASDAQ or the S&P 500 being a currency trader, but what we do need to know is that we're at a critical level of support or resistance. So over here on the 4-hour, we can see that the NASDAQ has had a 2050 exponential cross here. It's coming down to the support of 11.6, which was previous resistance. Pretty clear the market's found a key level. And if it gets and closes below here, what might happen to the odd US dollar? Well, based on our sentiment and based on our analysis before, they're kind of linked. So if the S&P 500 or the NASDAQ are closing below, we may see the Australian US dollar fall actually. At the same time though, we're probably going to be seeing people buy into potentially the US dollar itself. So we just saw it bounce a little bit there on the stock market, is in the NASDAQ. The US dollar is bouncing off this 92.60 to 92.80 zone. It's been pretty short this week, hitting that 20. Look at the magical 20 over here on the 1 hour, shorts off. And then it's gotten through that previous 93 zone. So we may now see a little bit of strength in the US dollar, and it comes back to the 93, hits resistance, and then bounces down. These are the types of things, they're all linked together. So once you start looking at the instruments, you don't have to trade them, but you need to understand what they're telling you. Don't read necessarily what the news is saying. Let the price action tell you what's going on.
Price action tells you everything there is to know about the market. There's no question about that. So indicators are always secondary. It is very, very important to remember that. I know we do harp on about it and we talk about indicators a lot, but they are secondary to price. So most importantly, understand what price is telling you and then use the indicators as the backup tool to support what you're already seeing.
So things that we're seeing leading into the election tide, they're going to affect our currency or Forex or any trading. Number one, fear coming back into the markets, uncertainty coming back into the markets. Good, again, if you're a day trader or a scalper. Why is that? The VIX increasing basically means fear is increasing in the stock markets around the world, and therefore everything's going to move more and faster. This increase is something you want to be looking at. We've got a 2050 cross here on the Pepperstone VIX, 2050 cross over here on the 4 hour. We've seen it increase, and the more this increases and spikes, the more movement that you're going to have through all the pairs, and it's going to be very aggressive. So as you see the VIX rising, and it consistently is rising, you can know that you want to get down and dirty in the charts in terms of the smaller time frames and probably predominantly trade in that direction of the trend at that point. When the VIX starts declining, it becomes more of a technical swing trading market. The more declining VIX, the more you want to go more to the swing trading style. So I think that's very important coming into the election. We're probably going to see increased fear, and that's because the election's tight. It's going to be increased fear most likely.
And the market doesn't really know, and the thing with the election is the market doesn't really know what to expect from either party. Now, the thing is, we know that if Trump wins, Trump is very pro tax cuts. We know that. But along with the Trump tax cuts that he brings to the economy, he also brings trade wars. And trade wars are something that, unstable a market. There's no question about that. Whereas a Biden win, he wants to increase taxes, so that's not going to help the economy in the short term. But there's probably going to be less conflict with, I guess, their allies, like the US allies, Australia included. It's going to be a more stable proposition moving forward. So it's not necessarily a bad thing or a good thing for either of them to win, but it's going to affect the market in different ways. And probably in 12 months' time, the market will probably be in a similar place no matter who wins. So I think it's more about the volatility index is really telling us that the fear in the market is because of the unknown. It's not so much that it's scared of one winning than the other. It's more about an unknown commodity, I guess. And if Trump happens to win, there's probably going to be a sugar rush to the market because that sees a very short-term increase. I guess they're going to look at that as a very short-term uplift to the stock market, which is going to affect every currency. It's going to affect the dollar index. It's going to affect everything dollar-based. Whereas a Biden one might be a bit of a slower burn. But the fear index is basically saying that they don't really know, as well, none of us do. So when you don't know, fear the worst, and that brings volatility to the market. And volatile markets are a time to be scalping. So that's why we're looking at the short-term opportunities at every opportunity.
Yeah, I think 2 weeks out, Ty, it just becomes a little bit too risky to maybe take some of those larger time things in, just purely the volatility. So we talk about the top-down approach. We still believe that's one of the best ways of approaching any time frame, going at least 3 time frames above what you're looking at and getting an idea or a sense of the market movement, a sense of the money movement, a sense of what's going on. Remember, the smaller time frames are always going to be dominated by algorithms. They're going to be dominated by big banks. And when movements happen on the bigger time frames and they close below key zones, that quick strike in the market, that quick movement, it's becoming faster and faster and faster. Even since 2008, I think the markets on the smaller time frames have been so quick to fill ranges. They're becoming more efficient, quicker, all of those types of things. So you need to move with that, and multi-time frame analysis can help you. Of course, using lines, bars, and candles, we talk about that all the time. and also understanding price action from a perspective of peaks and troughs. Now, this is something we talk about a lot in our courses, our masterclass, which we do have a sale on at the moment, but understanding price action, understanding peaks, troughs, multiple timeframes through them, and reading it without an indicator is actually very key to the markets. It's one of those things that you want to be doing. And troughs and peaks are something that can help you understand. Now, everyone knows that if you see a market like this, it's up, but it's understanding the nuances of that. The edge that you're going to get in trades is going to be very, very small. Why is that? Because the edge is going to be defined by little incremental knowledge base points that you're going to have across multiple reasons. And the reason we always say 3 to 4 key points to have it is each one of those, you might have a 3 to 5% edge. If you've got a 3 to 5% edge per indicator that you're using, and you add all of those knowledge-based indicators together and bring them all together, you might be able to get a 20 or 30% edge. And you'll usually hear people saying this is what they're looking for. They're looking for an edge on the markets. The best way to do that is bring together multiple reasons. Things like channels, easy to spot, horizontal support and resistance, incredibly easy to spot. Go to the smaller time frames, 5-minute channels, 15-minute channels. Doesn't matter what time frame channel. When it breaks out, the most conservative type of entrance is always going to be wait for the breakout, wait for the retest, and what we call the 1, 2, 3. So you'll notice here we've got 3 resistance points. We've got the first touch, the second touch, and the third touch. If you ever see that type of thing on a time frame, very easy price action way of looking at it is if it pulls back to that area, it basically breaks out, closes, confirms it wants to go to the next zone. When it comes and pulls back, this 1, 2, 3 becomes a great point of buying or selling opportunity. And that's something that makes channels very, very easy to spot and look at. Double bottoms can also be the same way. You might not get a 1, 2, 3, but you may get a coiling effect before it breaks. Another very solid pattern. I believe, Tyrone, could you post in the room as well? We've got a free cheat sheet that has some of our patterns. If you haven't seen that before, definitely check it out. Maybe laminate it, put it on your wall, put it on your second screen. A lot of people ask us, how many screens do you have? Well, we used to have 12 screens on one computer. It's a bit too much. You get burnt, don't you, Ty? You get sunburned from that many screens.
But you do, yeah.
And you have probably about 3, I reckon.
I think 3 is ideal. I feel a little bit claustrophobic when I go down to 2, to be honest, and then 1 is almost impossible to work on for me. But I think it's what you get used to. But look, if you can somehow facilitate 3 screens on your desk, it's going to be a really big advantage because you can have a lot of information at hand without having to shuffle through screens. It certainly makes a big difference.
Yeah, I think 3 screens is the perfect amount. In fact, I quite like having 1 vertical as well. So you have 2 that are horizontal like normal, and then you have 1 that flicks vertically, and you can use them all for different things. The vertical one's great for news feeds and everything productive, and then your central screen is going to be your main one, and then your other landscape one is generally going to be something to do with having all of your charts on there, and then you want to have a few screen and profiles. So more screens doesn't equal better. It just means that you have the opportunity to have more information in front of you, but you don't want to overcomplicate things. So as we said, if we're going with indicators, MACD, RSI, stochastic moving averages, some of our favorite indicators, some of our favorite chart patterns, things like channels, horizontal ones particularly, inverse head and shoulders, double bottoms, double tops, those types of things. And of course, the number one is probably going to be support resistance with purely just role reversal, the concept of effectively resistances turning into supports and supports turning into resistances. You're always going to get yourself in the direction of at least that time frame's trend. That's a benefit. You're always going to see confirmation with this type of thing, and you get the opportunity on the pullback to get a better price, which helps your psychology, and you can bring in your indicators there as well. We could have RSI coming down to a level that makes you think, okay, it's a bit better now for me to get into it. It could have stochastic going into the oversold. All of those types of things can happen with role reversal. It's why we always talk about it all the time, because it's so good. Now, Ty mentioned this before. Don't FOMO, Ty. I actually just got a coffee mug that says this on it. And I think I'll have to present it to a few people, because it's the biggest rule. It's the biggest rule when it comes to scalping and day trading. Do you want to talk about that a little bit?
Yeah, look, fear of missing out is It's one of the things that brings most traders undone. We had, I mean, I will mention it. Look, we do a Tuesday market watch for our private group every Tuesday, where I analyze the best trade for the day and basically put a video on it and put it into the group. Now, we've had, I'm not going to mention any names, obviously, but we've had a few people recently miss out on a couple of them because they watched the video a little bit late. And unfortunately, they missed that Tuesday watch, and the market went in and did its business. Now, yesterday was one of the ones where everybody had to be patient and wait for a level, and I was astounded at how many people actually jumped the gun and got in, and their reasoning was they were actually fearful that they were going to miss out on this opportunity because they'd missed the previous weeks. Now, this is just a really basic example of what FOMO actually is, but it's amazing how it can bring you undone, because it puts you in a mind frame that you're not really looking for the right setup. You're not waiting for the right trade. You're not waiting for the right signal. You're more worried about actually missing the opportunity. Now, the opportunities are always there for you. Okay, you're going to get the opportunities as long as you do the research, you do all of the checking. But FOMO will bring you undone, and even experienced traders, I noticed that even yesterday, can be guilty of that. So it's a laughing matter when we talk about it in this context, but it's no laughing matter when it comes to successful trading. You've got to take that and stamp that out of your trading and take the opportunities that present themselves at the time that you're trading. Don't worry about what everybody else is doing. Don't worry about what everybody else is seeing. It's just very, very important that you have the patience to wait for the right setups. There's many setups every single day. Don't worry, the market will be there for you when you are ready. Don't jump on board a moving train unless it's safe to do so, and that's at the 20 moving average.
This is the example, Ty. You could be the person that gets the breakout and think, yes, I'm the best, or you could be the person that is patient, waits for the pullback, and gets the better risk reward, and that person is going to make more money over the long term. And why is that? Well, because the problem is, if you always take breakouts, a lot of people don't consider this when they're looking at scalps and stuff. Where do you have to have your stop loss? So if you have a breakout candle like this, some people might just place it below the candle. Well, you're probably going to get stopped out majority amount of the time. A lot of the other people will see the breakout. When the breakout occurs, they'll get into it here and they'll have to place the stop loss underneath the last swing. The thing about the conservative entry is that in this case, you've got the 1, 2, 3, 4. So you've got 4 touches. It comes back down to the conservative entry. We get a hammer at the conservative entry. Now, what do we know? We place the stop loss below the hammer, and then we take it in the direction. We wait for it, the market to get slightly higher point. We've usually got a moving average coming up to it as well. So we might have that magical 20. We might have oversold stochastic on one of the time frames. We've got our hammer coming off the right area and a 1, 2, 3. All of those things together, we have a very small stop loss, potentially, or at least smaller than the breakout trader. We get a better risk reward, and we also don't have to necessarily be in the market for as long. We get higher statistics, all those types of things. Being patient pays.
Definitely. And look, I think I've said it about 3 or 4 times this week in different events that we run, even in our Q&A last Thursday, that you don't have to be the first to war. Okay, you don't. The night walkers are not the ones that attacked the wall. They're the ones that came in after all the dead skeletons broke the wall down. And it's just like chess. When you're playing chess, all the important pieces are behind the front line. It's the little peons that move forward and do all of the attacking, and then the big. Then the big players like the kings and the queens and the castles come in after the damage has been done. It's very similar to trading. You don't need to be the one that breaks down that resistance or support first. When you let it unfold and the market come back to you, you're entering a battle zone that is a lot more established. And I know it sounds like a strange sort of analogy, but it's the way it works. You're letting the wall break down before you actually make your move, and the path is a lot clearer once support or resistance has been broken and a retest comes to that zone. It really does open up the playing field for you, and you want to be the one taking advantage of the clearer path, not the one breaking the wall down.
You never want to be the one trying to break the wall down. Don't try to fight the system, flow with the system. That's the easiest way to do things. So 3 indicators that a scalper can use. Well, I'll give 4. So we mentioned it this time: stochastic, MACD, moving averages. Now, stochastic and of course RSI. MACD and stochastic generally range-bound markets. However, you can use stochastic in a trending market, but you can't use it against the trend. So if you thought that this was, yeah, it's overbought on the stochastic and the trend's up and you're selling it down, it's usually a bit of a rookie mistake, because the problem is that you might get it right sometimes and feel great about it, but going with that directional flow is much easier, as Tyrone was just mentioning with his analogy. We want to be doing that as much as possible. So really, if you had a few indicators and this is all you use, there would be no problems with that. We usually use the 20 exponential, 50 exponential, and 200 simple. And you can bring on smaller ones. We bring on the 5 and the 8 sometimes if we're in a really small time frame. But we find that the 20, the 50, and the 200 make the most sense. And some of the reasoning behind that is if we think about 20 periods and we go to a daily, we always mention this one. What is 20 periods? It's about 1 calendar month of trade, because about 4 weeks in a month, 5 trading days, 20 days. That's how things need to make sense. If they make sense like that as an indicator, then you're talking about trading human psychology, and that is the markets. Remember, someone wins, someone loses, Wall Street always wins. And overall, that's because it's taking advantage of our basic human interactions. We all make the same mistakes. You'll hear that time and time again when you read on the internet, oh, I made the same mistake as you, and you will do it. The idea is that you try to learn before you make that mistake and you don't lose that money and you get to the end before, of course, some of the perils are in there. So stochastic indicator, we use this slide quite a lot, Ty. It's just a little bit of an example of overbought and oversold areas and how you can do it in a range-bound market. Obviously, if you have a market trading within a range, you could always use both sides. But if it's in a trend, you'd want to be using in the direction of trend. So that is, if you're in an uptrend, you'd be looking at oversolds and then looking at buys with potentially role reversal and other things. So the stochastic's pretty simple. It's pretty good and pretty powerful. So what other things do we want to be looking for into the US election? Well, I think we've covered today that we want to be going with smaller timeframes for the next couple of weeks, day trading, scalping, those kind of opportunities, using our swing trading methods, potentially daily closes, 4-hour confirmations, all of that, and then trading the smaller moves. We saw dollar index today get very heavily hit. We saw big moves on the markets as well the last couple of days, and this is off the stimulus calls. Then we're going to have, no doubt, a lot of election kind of volatility between the two parties. It's very close, and the day of the election is going to be super exciting. It's going to be one of those days where I think it's worthwhile almost just taking the day off and watching the markets, isn't it, Ty? I mean, I always get excited around this time of event.
Yeah, no, it's definitely one we're looking forward to, and it is fine. Look, it's finally getting there. It seems like, yeah, this year has dragged out for so many reasons, but yeah, we're only 2 weeks away now, and it's going to be a good time trading, and we're going to have certainly plenty of scalping opportunities in the next 2 weeks. That's for sure.
So sound risk management, we always want to be trying to risk between 1% and 2% of capital, Ty. We want to be trying to find risk rewards that make sense. If we're going to risk $100, we want to be trying to make at least over $100 in our trades. Otherwise, we're doing ourselves a disservice. Don't go for, I guess, the honey pit. Don't go for the golden goose of 10 to 1 and 5 to 1 every trade. It's not necessarily always out there, but slowly and consistently building up your balance using 1.5s, 2s, 1.7s, 1-to-1s, all those types of things. That's how most people do it. 10-to-1s happen, but not all the time. And I think that's a really important kind of message out there. They don't always happen. Yep. So tie into the election, we do have a special, our technical analysis masterclass, 25% off. You can use coupon election25. And you can of course go to our website at fxevolution.com, check out more about that. I think a lot of people find this very valuable. It's a culmination of everything that we've learned over the years. We put it into a massive technical analysis masterclass from beginner to intermediate to advanced. I would say it's one of the most complex overall courses, and we've got some great reviews from it, Ty. So, I mean, what do you think? It's taken a while.
It is, yeah. Well, the people speak, and you only have to go to the Discord room to know what people think of it. So it's really, really important to be educated and understand what you're looking at, because all of the concepts that we talk about on a weekly basis at Pepperstone's webinars are always basically based on what we teach in that course. So we do have a couple of housekeeping items that we need to make you aware of. Obviously, we're going into an election, so it's never been more important to be part of the Pepperstone Telegram group. If you're not already part of that group, definitely get in there. It gives you daily alerts on anything that's coming out. We've got you know, the Trump show rolls on. We all know that. So after, not really knowing what he's going to come up with next, it's really, really important to have someone that's going to give you up-to-date information. So the Telegram group is also really, really good for that. And also after this webinar, there is going to be a small survey. If we could just get people to participate in that and just quickly fill it out for us, because it helps us work with Pepperstone to produce you the best content that we can, to basically make it as good for you as you need it to be for the times that you're trading. So, you know, some people want scalping, some people want swing trading. You know, put your thoughts forward, tell people what you think, so Pepperstone can really accommodate and get the webinars that you're really wanting to learn from out there and available to you.
Yeah, thanks very much, Ty. So I think that probably brings us to Q&A, and always great to have some questions. So we've got a couple of questions here. I trade in Australia, and I'm wondering, what is the best time for me to day trade or scalp? Well, it's a great question. It really depends on your working balance and what your work-life balance is going to be. So I think one of the things that we always say is Tuesday, Wednesday, Thursdays are the best trade days of currencies. They always have been. They probably always will. It's because we give all the markets the chance to open. But if you're trading the Monday session, and let's say you're trading early in the morning, you'll want to be very careful in what you pick. Possibly Australian pairs and possibly yen pairs will make the most sense, or Chinese pairs, because the thing is, those are trading in that session. Therefore, they've got real market volume. Whereas if you're trading a US-based pair or a European-based pair, they haven't opened those markets yet, just futures trade technically. So it's worthwhile considering that process. Now, in terms of best time frame, as we mentioned, 30 minutes to 1 hour before the session open. So that is usually the stock market open, or you can just search it in Google and have a look at London open currency or anything like that, and then come in about half an hour before and do your analysis. That's the best way of doing things. Most Australians and people in Oceania, I guess, will be looking more at the London Open, which is probably one of the best times to trade anyway, because that'll be after their work life, after their work day. A few people are just asking about the cheat sheet. I've posted that in the room. If you'd like to get that, that's free. That's just a quick cheat sheet on, of course, access to some of the best some of the best patterns overall. And I think that probably brings us to an end. We've answered a lot of the questions throughout today's session. So thank you very much for joining us. We do have another webinar just coming up, which is going to be us looking at the live markets right now. If you'd like to come and attend to that, Tyron's put it in the room. You're very welcome to come and join us. And we do that every week as well. So we'd really like to thank everyone's support throughout this US election. We think that it's going to continue to be fireworks, and we hope that you learned a little bit about how things change throughout the process. A few weeks ago, we were looking at swing. Now we're looking at smaller time frame moves. And then after the election, probably back to swing, isn't it, Ty?
Yeah, that's right. So, and the thing is, what you'll find is, the methods actually change and interact with the market movement, but the concepts that we talk about actually don't. And I think that's probably the most important thing. So it's really about understanding the markets that we're trading. But look, thank you very much for joining us for this 3-part series. Now, the next Pepperstone webinar will be post-election, I believe. So look out for your invites there. They'll organise invites for the next date, which will be early in November. But yeah, thank you very much for being part of this series. We hope you enjoyed it. And don't forget, if you've missed any part of it, or you want to recap on the 3 of them, they're available on the Pepperstone YouTube channel. So along with all of the webinars that we've done in the series. So there's a big library there. Certainly check it out, because they're always there for you to learn from and refer back to.
I will answer this one last question here, Ty. During a retracement, when should you get out and when should you hang on? So I think with retracements, usually if you're looking at a fib pullback, try to go between a 38 and a 50 fib is actually a very normal retracement. If it gets past that 61.8 and what people call the 78.6, the dreaded number, the 78.6 often means that the trend is over. You're basically saying it's moved really far up and it's retraced way too much of a percentage of that. When that happens, it usually is no longer in a strong aggressive trend. Strong aggressive trends hold 38.2 and 50 fib levels. That's what you want. You don't want it to the golden ratio. You want it in those nice psychological levels. And just think about that from a human perspective. It'll make a lot of sense. All right, thanks everybody. We'll see you in a couple of weeks' time, or we'll see you in a couple of minutes. Bye for now.